Hello, everyone. Welcome to Asset Class, where we look at the latest news in the financial market. Today, we'll be looking on a clip by Michael Saylor, and he's talking about how he views the cryptocurrency market in terms of the four quadrants. I think it's some excellent perspective, and this video is being shared from another YouTube channel that's called Podcast Clips. I think it's some excellent perspective, and I'm going to go ahead and share it with you, and I'd love you to share your comments and thoughts of what you think about the four quadrants of crypto. Of course, we know about the four quadrants in terms of Robert Kiyosaki being the E, the S, the B, and the I, being employed, self-employed, being a business owner, and then an investor. But now we hear Michael Saylor putting cryptocurrency in a similar four quadrant. Go ahead, view, comment, and share your thoughts.
Let me give you a model, a four quadrant magic quadrant model. I think that I'll start with the observation, cryptocurrencies mostly aren't currencies at all. Cryptocurrency is a misnomer and it creates massive confusion. And I think people in the space are confused. I think people out of the space are confused. And I think a lot of people that speculate in it, they speculate just in these things without having a long-term thesis about what they're doing. Here's the way I would segment the space. Four quadrants. You have digital property. Bitcoin is the king of digital property. It's optimized for integrity and durability over long periods of time. The idea is I want to take $1 million, buy Bitcoin, and I want to hold it 100 years, maybe 1,000 years. Imagine owning a city block in London. Your family owns it 300 years ago. When would you ever sell it? Never. Do you want to sell it? No. How are you going to live? You're going to generate yield on it through rent by lending it out to someone else to build a building on, or you're going to finance it and you're going to borrow against it. How long can you do that? You can do that forever if you're actually a smart landlord. It's not a currency. If you owned 10 city blocks in London, and I think like the Duke of Wales owns, parts of London. You probably know the history. A lot of the land doesn't trade hands. If you own 10 city blocks in New York City, your family might keep them for 300 years. If the Fed keeps printing 10% more money a year, you can expect your land will go up by 10% a year because it's scarce, it's desirable. You can continually refinance it. When you have $1 billion of it, it goes up by 10% this year. And then you have 1.1 billion and you borrow 50 million at 3% interest, and you have no capital gains tax. You have no income tax. It's a simple business. That's digital property. Digital currencies are Tether, DAI, Circle. DM will be a digital currency, a CBDC. That's a digital asset that's seeking to be a stable currency, and it's a medium of exchange. If you want a high-speed decentralized medium of exchange where you can move $50 million from Zimbabwe to Emirates on Saturday afternoon, outside of the Fed wire, outside of ACH, outside of the banking system. If you want to give everybody in El Salvador $37 on their mobile phone, you got to do it with a digital currency. So this is not a subtle thing. It's 8 billion people need a currency. The currency is the medium of exchange. The property is the store of value. Now, the third quadrant is a digital platform, Ethereum. It's a platform. They want to create a platform where you can create applications like a decentralized exchange, an insurance company, NFTs. Decentralized applications is their mission, but they are a platform for it. When you buy a ETH, you're buying an asset token, a digital asset that gives you a share in that digital platform. And then the fourth quadrant is digital or decentralized applications, Uniswap. Right? They're trying to replace NASDAQ or Coinbase or Binance Smart Chain wants to replace Binance, a centralized exchange. So here, looking at the picture behind you, Sven, I give your family $1 billion and I say, you can either buy $1 billion of land in London or you can buy $1 billion worth of buildings in London, or you can buy $1 billion worth of the British pound, or you can buy $1 billion worth of companies in those buildings. Okay. The British pound is the digital currency. The land is the digital property. The buildings are the digital platform. The companies are the digital applications. You understand the upside, the downside, and the risk profiles of each of those four? See, the land will probably be here for 500 years, right?
Absolutely.
Right? The building's probably got a useful life of 50 years to 100 years max.
Hey, in the background there are some buildings that are around 500, 600, 700 years. Yes, but
Maybe some.
yeah.
Yeah. And then there'll be
St.
like
Paul's Church, for example.
yeah, so it might, by the way, some might last hundreds of years.
Yes.
And then there'll be like the some where they'll take it down because it's no longer competitive. How about the companies? Name a company in London that's been around for 100 years.
Oh, most of them are gone, right? I mean, that's the cycle of life.
So that's the best way to understand the crypto economy, right? The digital currencies have to be compliant and compatible. They have regulatory risk. There's not a lot of upside to owning those, by the way, but you need them as a medium of exchange. If you want to trade in and out of them, you got to have them to lubricate trading and DeFi. And you also need them to buy coffee. In El Salvador, they want the digital dollar to buy stuff with, but they want the digital asset, the Bitcoin, as a long-term store of value. Think savings account, checking account, or think in terms of working capital that I need in the next 12 months versus corporate treasury that I need to hold 100 years.